All right. All right, class. Welcome to chapter 15. Chapter 15, where we get into some more 230 type things. And let me share the screen with you, Rod. Hold on. This thing's giving me trouble. I thought it was in a 3-hour meeting starting at 2 o'clock today. And thank God Cornelia happened to call me and tell me it was Friday, which is much better.
A 3-hour meeting is a long meeting.
Oh, yeah, some of these meetings are unbelievably long. And they're participatory. You're on Zoom and they expect you to be chipping in your 2 cents every few minutes. Okay, can you see the PowerPoint now, Rod?
Yeah.
Okay, I think you'll see this chapter is not too terribly tough once you understand some of the terms and how this is kind of flowing. I really wish this chapter was done when we were doing the first 6 chapters. It seems out of sequence to me, but we'll work with it. What we did before was called a simple income statement, a single step, in that it was essentially you just listed all your revenues, got the total revenues, then you listed all of your expenses, got the total expenses, and there's your net income. So we're introducing a multiple step now where we're going to talk about gross profit and cost of goods sold and things like that. So the income statement, we know what that is. It's to summarize the results of the operation. It is not a snapshot in time. It's what happened over a month's period or a year, whatever. And the single step is what we've done all semester. Let's look at the multi-step. The single step, all the revenues are listed. Cost of goods sold is listed with other expenses. And that's the key difference. Cost of sales under the single step was just another expense. It's an expense that is representative of what you paid for the goods you sold. You sold a dress for $1,000 and you paid the tailor or the seamstress $400 to put it in your store. The $400 is the cost of goods sold. And that was the single step. And we can see it's pretty simple. Huh, Rod? We got different kinds of revenues and they're all up on top. And then all the expenses are listed, starting with cost of goods sold. So this company made a profit of 100,400. And I'll bring your attention to the top up here where they're listing the revenues. We see sales. And now we see interest revenue, rent revenue, and subscription revenue. The interest revenue is probably not going to be shown up on this part of the multi-step. It's going to come after operating. And that's kind of what we need to understand here. Gross sales is shown first. The gross is sales. And we show it, and we also show the reductions in sales returns, sales allowance, sales discounts. Those are contra revenue or contra sales account. And we end up with net sales. And net sales, Rod, is 100%. And I'm saying that for a reason, 100%. Everything below that in your income statement is going to be expressed as a percentage of the sales. So gross sales is shown first. Then they're going to show just one expense, cost of goods sold. Cost of goods sold. And when we subtract that from net sales, we're going to come up with something you're seeing for the first time, I think, gross profit. Gross profit. And that's just a measurement of how much you're paying for your goods minus what you're, minus against what you're selling them for. And then they're going to list after that what we're going to call operating expenses. Operating expenses. Expenses that are directly related to the core business paradigm. Expenses like buying something from a vendor, paying your employees, rent on the factory, all kinds of normal things. Operating expenses are directly associated with providing primary goods and services, as opposed to interest income or interest expense, something like that. Operating expenses can be divided into the categories of selling and general expenses. I'd rather that said selling and G&A, general and administrative. What are selling expenses? Well, you probably intuitively thought, well, I bet it's part of the salaries of the salespeople. It's going to be their commissions. It's going to be advertising expense. When you sell something with a credit card, that's going to be considered, if you do something with a credit card, that's going to be a credit card expense, delivery. But it also, Rod, includes all other expenses you can think of. Your sales force might have their own building. They have cars that they drive around the country. They get benefits, they get salaries, they have travel expenses, they have depreciation perhaps. So any expense can be called a selling expense as long as it directly relates to the movement of the product out to the customer. Everything else we call general and administrative. Expenses associated with administrative officer general. G&A is what the world calls it, general administrative. And again, this can be any expense you can think of. Rent expense on the offices, the accounting department, the stationery supplies. Oh, it could be anything. This is the accounting department. This is the purchasing people. This is human resources. These are the executives, the secretaries, etc. Okay. And the reason we separate them into the multi-step income statement is you want to know how you're spending your money. You want to be able to look at the selling expense pocket and compare it to budget and see if you're hitting your targets. And it just provides more information. Can you read this, Rod?
Yeah,
or should I make
fine. I can read it.
Oh, excellent. Okay, I actually can read it too. All right, let's take a look at the multi-step, okay? The multi-step. And I'm just looking at the left here. Here, the first two columns here, Rod, that's our spreadsheet, okay?
Yeah,
That's that long 10-column spreadsheet. And now we moved everything over to the adjusted column. Now we can pick off all of the income, all of the expenses from here. Get a look at the multi. Can you read that side too, the far right?
yeah, it's a little small, but I can read it.
Okay. It's all about me, Rod. I can't see it.
Yeah,
Okay. Sales here's what we're looking at. This is gonna be the old multi-step. You have sales less your sales returns and allowances, maybe sales discounts, maybe credit card fees, okay? So you go from gross sales or gross sales, to net sales. And notice we put those net sales out on an island way to the right.
yeah.
That's a good presentation. I mean, none of the presentation issues are set in stone, but you want to make it look readable. Now, here's the hard part. If I don't want to call it the hard part, because that's not that hard. Under this method here, we're going to show the calculation for getting cost of goods sold. And I bet this drove you crazy on the homework, no?
Well, on the fourth problem, they didn't give you the starting inventory.
Okay, I'll take a
And
look.
they didn't give you the estimated returns inventory.
Yeah, we're not. I hate to frustrate you. We're not even looking at those estimated returns. We're not even teaching that. Remember, I told you you shouldn't get you should not get that problem in your homework.
Yeah, but they didn't give you those yet. I had to work it all backwards.
Yeah,
to
you
get
might
it
have
all
had to plug the
done.
number. Yeah, let me take a look at it before we get done
Yeah.
here. But what we're talking about here is on the multiple step, it shows great detail on how we came up with our cost of goods sold. We take the beginning inventory plus the net purchases minus returns allowances minus purchase discounts. So we take beginning inventory plus net purchases plus freight in, not freight out, freight in. And that's going to give us something we can call cost of goods available. They're giving us a separate column here, a separate line for cost of goods purchased. You don't really need to do that, I don't think. But
Well,
take a
because
look
they're
at
adding it with the estimate from before.
Yeah. I'm deliberately ignoring those
Yeah.
estimate numbers, but yeah. So your beginning inventory was 52. Then they had the estimate, which we'll put in there. And we add the cost of goods purchased. And now we're up to the famous goods available for sale. That 292,100, Rod, that's the most you could have possibly sold, right?
Right.
We had a beginning inventory of 53,000. We brought in 292 more. Or 238 more, 292. And I'll do it again for the class. Just think of the 53,200 as books, not dollars. You had 53,200 books. You purchased another 238, so you had 292,100 books that floated through your bookstore. That's the most number of books we could have sold. What do we do at the end? We subtract the ending inventory and the estimated returns. And we come up with the cost of goods sold. Cost of goods available minus ending inventory equals cost of goods sold. And we remember that, right, Rod, from prior chapters?
Yeah.
So here we go. We got sales, net sales of 465 minus the cost of goods sold gives us gross profit. Okay. Want to ask any questions so far, Rod?
No. It's all good.
Okay. Now, that's the tricky part, if you will, of the multiple step. Now, look how easy it is for operating expenses. Notice they're lumping all the operating expenses under one section. Normally, class, you would have operating expenses, and then the next line would say selling expense, and then you list all the selling expenses. Then you'd have operating expenses for general and admin. Here, they're lumping them together. I don't know why, I guess to make the presentation a little bit easier, but that $71,000 you see for wages, that covers the accounting people, that covers the salespeople as well. So look what they're doing here. They're just listing down the various expenses and coming up with the total operating expenses. Now, somewhere in your book, it said something about you can sort the expenses in order of high to low dollars. That's nuts. You would never see that.
Yeah, no one would do that.
No one would do that because you can never compare them month to month.
No, yeah.
You know, next month maybe advertising was 100,000. Anyway, I'm preaching to the choir here. So total expenses are 128,900. Income from operations. Income, you can call it net income from operations. And you remember we had things like interest income and other things that were counted up on the top with the sales. Under this method here, the interest revenue, the rent revenue, and the subscription revenue are considered other revenues. And that's a key difference between the simplified single step and multiple step. Interest revenue has nothing to do with whatever this company does. If this company is a restaurant or something, the fact that they have interest revenue just means they had some cash that they were able to loan out to somebody. It has nothing to do with selling food. Rent revenue is the same thing. That factory I worked for many years in downtown Los Angeles, we rented part of that building to some artists. It was we had lofts, lofts downtown Los Angeles. We were renting those out. That was other revenue. I don't know why the subscription revenue would be here. I mean, if these guys, if they normally, their business is magazine subscriptions, that would be on the top here for some reason. Okay. So you have total other revenues and you have other expenses, interest expense. There could be something else there. You could have, well, when you get to 230, you're going to be doing amortization, depletion. Maybe you sold off part of an old division, things like that. So that's a pretty good peek at the multi-step. We're okay so far, Rod?
Yep.
All right, let's see what Cengage brings us. prepare a statement of owner's equity. What they're showing us now, Rod, and I'm going to go back up here real quick. What they're showing us is how to take this spreadsheet, how to take columns 5 and 6 here and move them over to the financial statements. So they're on here, they're just showing the income statement items and showing you how to bring them over. Now they're going to show us a different part of the, well, they're not going to show it to us. That's a little annoying, but prepare a statement of equity. We did the income statement of equity. Summarizes all the changes in the owner's equity. All we're doing here, Rod, is beginning equity plus net income minus dividend, or not in this class, minus drawing equals ending inventory. Beginning balance plus net income, beginning balance plus income minus drawing to ending. You got to bide your time, BIDE, when you do this report, okay? Beginning, income, drawing, and ending. This is not a difficult report, but students get a little stunned by it for some reason. So here we go. Here's a very good example. And this one's actually extra complicated, which I think demonstrates how easy it really is. Remember what we said, beginning equity. This guy had he had a business that was worth $407,200. That's the beginning. And then he threw in another 10,000 of his own money. Okay, so that just changes the beginning, I guess, to 417,200. Okay. He made money. He had a nice profit. He had a profit of about 25%. And he took withdrawals out. Maybe that's how this guy pays himself. So the change in capital is a plus 96,400. And there's your new capital. Good with that, Rod?
Yeah.
Okay. Prepare the classified balance sheet. Well, this isn't any more difficult than the single step income statement, but let's take a look at it. Again, here they are showing you the balance sheet portions of the spreadsheet, okay? The balance sheet portions of the spreadsheet. And they're showing you how to bring them over. And I'm going to make this a little bit bigger. Zoom. I said zoom. There we go. Okay. So they're bringing everything over from the worksheet. Now, right away, you see a difference here, Rod and everybody. Before, we just listed all of the assets, right? We just listed them all one by one. We call them total assets. Now we're breaking them out into current assets and what we'll call non-current assets, like property, plant, and equipment. Other non-current assets could be amortization, unamortized items, could be a lot of other things in there, okay? But our current assets are the ones we chew up within 1 year, right? Have we talked? We haven't talked much about current assets, have we, Rod, at all?
It was in the book. Yeah.
It's in the book, yeah. But this chapter, I would recommend at the next faculty meeting. This thing should be like chapter 7 or something. Come in and move everything else back. Current asset. A current asset is any asset which you expect to turn over in 1 year.
And the fiscal year.
In a fiscal year. That's exactly right. Cash is another way to say it. You're turning these things into liquidity. You're turning them into cash, hopefully. Nothing more liquid than cash, huh? Accounts receivable is probably the next best thing to cash. Inventory, these estimated returns, prepaid supplies, prepaid insurance, current assets. And the reason you see companies breaking out the current assets from the non-current, it allows them to really do some analysis in terms of cash flow, how they're turning over their receivables, things like this, which we'll get to shortly. So we got the current assets, then we got the long-term stuff. Land, building, accumulated depreciation, equipment less accumulated depreciation. These are all non-current assets. These are long-term assets. fixed assets. Now on the test, they love to put a question like this down, everybody. They'll say a building was depreciated. A building was depreciated for $43,000. True or false? The accumulated depreciation account decreased. No, it increased, right? It's a contra asset account. And that can be a confusing thing. You need to think about it a little bit. So here in the second of three columns, they're putting the land out. Here's a true or false question, Rod. You want to take one for the team here?
Sure.
True or false? You never depreciate land.
You never. True.
True, you never do. And the gap.
That never goes away. It's always there.
Yeah, it's always there, and it tends to be unpredictable in terms of value, unlike I guess a building. So no, you never depreciate land. You're right; it's always there.
What was I tell people? There's no wear and tear on land.
Nope.
If you take
Nope.
a door, you open and close it, you're wearing it out.
Yeah.
You appreciate it.
Yeah, you put a building on land, you can always blow the building up and start over on the land. It's like you said, it's there forever. So let's see what we have here. We have current assets of 87.9 plus the fixed assets. I wish they gave us a subtotal here that said current total fixed assets like they did up here. Just a little nit. So we have total assets of $578,000. So now they're bringing over the liabilities. And again, we have current liabilities and long-term liabilities. A current liability is, can I just look at my phone real quick? I got a construction guy coming in later. Sorry, guys. I don't like to interrupt the class like this. It's from Cornelia. She should know better.
No.
Okay.
Tell her you're in class for real
I
this
should
time.
have said that live on the screen here. Didn't mean anything by that, Cornelia. You know, it's all good. Current liabilities. These are the ones we're going to pay within a year. That's within a fiscal year. Notes payable can be long-term or current. You can have both on the same note. If you have a note that's going to be paid, say, for 10 years, 1 year, the first year of that is going to be current. And as you pay the note down, year 2 becomes current, year 3, etc. Accounts payable. Accounts payable should always be listed first. I've never seen a balance sheet anywhere that started with notes payable. Accounts payable, then notes payable. These refunds payable, your accrued wages, sales tax, all the stuff. These are your current liabilities. The long-term stuff is here. You notice they have a mortgage in the current portion and they have a mortgage in the long-term portion. And that's a misprint there. That should say long-term portion under there. Same thing with the mortgage, like a note. Whatever's due in the next year to your bank is the current portion. So let's see. We've got current assets and long-term assets. We've got current liabilities, long-term liabilities. And then we have our equity. And the balance sheet balances, 578,900, 578,900. Get familiar with what's a current liability and what's a current asset, and more importantly, how to use them in some of these analyses. We're going to see a little bit in a few seconds here. Current assets. Let me move that there. Current assets. Cash and other assets, we're expected to turn them into cash within the normal operating cycle of the business. 1 year, and you said it most clearly, Rod, with the business cycle, the fiscal year. Operating.
Not everybody's on the regular year.
Oh, God.
Most are, but they don't have to be.
Yeah. One of the stocks that I own is General Mills, the cereal manufacturer.
Yeah.
And you might be interested in knowing that their fiscal year begins with the planting season. When do you plant when you're on a farm? anyway, it begins with the planning season and then ends right after 12 months after that. A lot of fiscal years were set up many, many, many years ago, and they follow the exact cycle of work. Department stores, Nordstrom's, they tend to have their closing at the end of February. Of course, they want to scoop up all those January sales at February, December Christmas sales. Makes a nice big splash in the fourth quarter. The operating cycle, you buy inventory, sell it, and collect, huh? Now, this is important. This is true. On your income, on your balance sheet, everything is listed in order of liquidity, your current assets. Cash is the most liquid. Accounts receivable is probably going to be the next one. Marketable securities would be very liquid if the company owned short-term note or something. Property, plant, and equipment, assets going to be around for more than a year. Assets with longer useful lives are listed first. I have not seen that before. Again, I don't believe that's necessarily true. Current liabilities. Again, the ones you're going to knock off within a year. Notes payable, the current portion of notes payable, accounts payable, wages payable, all accruals, all accruals are current liabilities. Anything you do, if you accrue salaries, if you accrue insurance expenses, something, they're all short-term. Sales tax payable is certainly current. The unearned revenue from subscriptions, whatever. Long-term obligations that will go on for a while. Mortgage payable is a common long-term liability. That's a good example. You buy a house and you sign a mortgage. It's an agreement the lender has to take over the specific property to satisfy a debt if you don't repay it. That's what a mortgage is, baby. And the first year of that mortgage payment, those mortgage payments are the current portion. Although, I don't know if I assume you're a homeowner, Rod, the first year or two payments on a mortgage, how much does that pay toward the principal? Almost nothing, right?
Yeah, the first 7 years where you pay the most interest and then it goes down.
Yeah.
There's a lot of those calculators online, like Carl's Mortgage, and they'll graph it for you. That's why it's not a good idea to refi too often.
Yeah. I remember when my mortgage payment was $204.17 in the first. I got the first year's statement from the bank, and I don't even think I contributed $30 to the reduction of the debt.
That's why if I tell people, if you pay $50 extra under principal, you're doing.
What a great idea. You're absolutely right.
So on mine, I do minimum 200 up to 500 a month extra towards principal.
That's money well spent. You're going to save, what do you think you'll save? Tens of
thousands. I have a spreadsheet on it.
Yeah.
120,000.
Isn't that amazing?
On the life.
Yeah.
By the compound.
Yeah. Compound interest is a wonderful thing. Take advantage of it if you got those extra bucks lying around. So long-term liabilities, owner's equity. These are the accounts, depends on the organization. Sole proprietorship, partnership, corporation. You will eventually probably take, or maybe you won't, but others certainly will take Bonnie Chavez's Intro to Business class. Bonnie's been teaching that here for years and years and years. He's been around here forever, and he'll go over these guys in great detail.
That's what I do all day.
What's that?
That's what I deal with all day.
Sole proprietorships?
Well, all of them. Because I have like 25 corporate returns, a ton of partnerships, and a ton of S Corps.
Wow. Yeah, it's like I said, that's why I was glad to have an outside party do my income taxes.
Like everybody comes in so confused.
Oh yeah, Jesus.
And it's like, man, I have a little mini class I give them now on the different structures, when to be going for it. Sole proprietor, S Corp, or when to be an LLC, why to be one or the versus the other.
Right. It's almost like a law class when you think about it too, right?
Well, yeah.
I
And
mean,
then I had a plumber this year who's a sole proprietor who was working for as an electrician, and he called ADP, and ADP put him on payroll. So
say
he's
that
sole
again.
proprietor,
Right.
and ADP put him on payroll. So now his profit and loss shows 60,000 in losses because he's been paying himself wages.
That defeats the whole purpose of the sole proprietorship.
I know, it's against the law.
My goodness, man.
So I
Oh,
called the
well.
IRS local office, talked to the head auditor, and I said, "Hey, how do I handle this?"
Can you
Because
actually
literally-
get a hold of somebody there?
Yeah, because I have an accountant, UCSB accountant working for me,
Yeah, yeah.
and he's taking the tax to UCSB extension on corporate returns, so he can
Oh,
help me.
okay. Oh, that's
And so
great.
he's the professor in that class. So hey, ask him about this.
Taxes, what a complicated area. Yike. All right, you ready for some analysis, everybody?
Yeah. Ooh.
Financial statement analyses. And these are basic things all investors quickly look at. You know, you're thinking of buying a stock, you heard some good things about it. I'm hearing great things about, I don't know, Tesla or somebody.
Buy
So
Neo.
what's that?
Neo.
Say it again.
Neo. NIO.
What is that?
It's a Tesla equivalent from China. They're
Oh,
taking off.
really?
Yeah, look
Really?
them up. I had a
Neo.
client buy it, I don't know, 8 months ago at $3 a share. They hit 80.
Can you what
They're
can you
now
buy?
at 30.
Yeah. Can you buy it
But
on
they're
Mhm.
yeah. Just go to Fidelity or wherever. They're there.
Oh, that's
It's actually
interesting.
around 36 right now a share, but it's a really
Yeah.
good buy.
It's a good recommend, huh?
Yeah, I bought a bunch for my kids.
Just and I hope this class forgives me for what might be the last bad joke
Yeah.
of the semester. Just don't make the investing mistake a friend of mine made, Rod. You know what he did? He invested all his money in a company that made toilet paper and revolving doors. You know, revolving doors?
Yeah.
It didn't work out. You know what happened to him? He got wiped
What?
out before he could turn around.
Yeah.
Terrible, terrible joke. Okay. Financial statement analysis. A lot of this analysis now is going to take two different statements and stick them together. So let's see how we're starting here. Balance sheet analysis. Let's understand what these three things are: working capital, current ratio, and the quick ratio. Working capital is simply current assets minus current liabilities. Okay, well, that's nice to know. Working capital. Sunflower has 127 in current assets, 34.8 in current liabilities. Working capital is 93,100. Well, an investor looks at this, Rod, or anybody else, and what they're saying is, well, they're very liquid in terms of being able to pay off every dollar of their current liabilities right now if they wanted to, and still have $93,000 left over. So they're in a pretty good position of solvency. That might be a pretty good ratio. Okay. But numbers can't be compared from business to business. You might be considering another company, and it's a company that's 20 times bigger, and 93,000 would be a meaningless number in terms of measuring against each other. So working
Apple.
capital, what's that?
Apple.
Apple.
Yeah. You know what they have liquid?
I can't hazard a guess, but I know there's hoarding cash. What do they got?
Like 2 billion liquid.
You know, ever since the disastrous financial failure of 2008, you know, as George Bush's presidency came to an end, companies really started to hoard cash, and they still are.
Yeah, they're hoarding a ton.
There's so much capital out there that everyone's waiting for them to throw into the economy, build another factory, do something, you know, but they're hoarding cash. Well, if the working capital is current assets minus current liabilities, let's divide it. The current ratio is current assets divided by current liabilities. So we're working with slightly different numbers here, huh? They're saying that the current assets were Yeah, we're working with different numbers. In this scenario here, this company has current assets of 87 million, maybe whatever, and current liabilities of 35.8. So they have a ratio of 2.5 to 1. These ratios are more meaningful in that you can compare companies across different sectors, markets, and sizes. So these guys have a ratio of 2.5 to 1. This means that they could pay off every penny of debt if they wanted to, and still have $1.50 left over for every dollar they pay off. So 2.5 to 1, that's a pretty reasonable ratio. At least, it shows they're solvent. If you have a negative ratio, if the liabilities were higher, technically you'd be insolvent, meaning you couldn't pay all your bills right away. But that's often a temporary condition. So
Well, I don't think you could have a negative ratio. You would just have
well,
a
not a
fraction.
negative ratio, but where
Fraction.
you
Less
don't
than
have
one.
in other words, if this was 100,000 in liabilities, yeah, the fraction would be 87%, but that would indicate they don't have any money left over to pay
No, that's what I'm
anybody else.
saying. If they were negative, and then it would be a fraction number.
Yeah. That's a good point. At Santa Barbara City College here in our textbook, we're glass hair filled kind of people. We never show those kinds of
Yeah.
bad ratios. Look at Tesla or somebody, maybe. But anyway, we have a ratio here of 2.5 to 1. 3 to 1 would be even better, right? 4 to 1, 5 to 1.
Yeah.
But what if it went up to say 40 to 1? Would that be good? That'd be great, right? But I don't think that's what companies should do.
Well,
What
probably
would
not
you
realistic. Yeah.
That's what they're doing though at Apple. They're hoarding
Yeah.
cash. If you're holding on to that much cash and you've got like a 20 to 1 ratio, you could very likely be missing out on so many good investment opportunities, right? You're
Maybe. I don't know.
holding all this cash. What do you do? Have it in a savings account, it pays 1%. Let's put it to use. Anyway,
Well, they pay good dividends if you buy the stock.
Oh yeah. You know, uh, everybody's got their regrets about the market. Boy, I wish I had bought it when Steve Jobs came back to Apple. I wish I was smart enough to say he could save the company, because you could have bought Apple for I might be wrong. It was as low as $5 a share.
Wow.
Yeah, you can look at that graph on easily on
Yeah.
Google. Yeah, it went down to $5 a share. There was a concern they would go out of business.
Wow.
And if you picked up those $5 shares, those shares went up to over 700, and then they split 7 for 1.
Yeah, because it's like 126 today.
Yeah, we'll multiply that by 7, and that's really what it was. And at 120, it's at 126. My God, at 126, it might split again soon.
Yeah.
You know what they say about the stock market? Everybody knows when to buy. Nobody ever knows when to sell, and that's kind of what happens. Okay, quick assets. Quick. What are the quick assets? Well, there's just 3 of them: cash, AR, and any temporary investments you might have in a marketable security. For example, you have cash, AR, and maybe you bought stock in another company. That could be considered a temporary investment. You could sell that in 2 seconds just by clicking on your computer screen or calling your stockbroker. So we're going to ignore the inventory and the prepaids here. So this gives us an even more stringent measure of our cash position. Now here, they're saying a rule of thumb is 1 to 1 is good. Okay. And they're saying here 0.6 to 1 is also acceptable. I think it's in the eye of the beholder. I don't know if that's how true those 2 rules are, but you can see here, we're not looking at no 2.5 to 1 anymore, just 1 to 1. And this tells the world that these guys can pay off everything and still have a dime left over for every dollar they pay off. Plus, they didn't have to go and tap into the inventory or the prepaids to do it, because those are assets you could actually sell. So the quick ratio, quick. Now we're going to get into some ratios, guys, where we're going to look at two statements and compare them. The return on equity, net income divided by average owner's equity, net income divided by average owner's equity. And we get that average by looking at the balance at December 31st, year one, added to the balance December 31st, year two, average it out. So this particular company takes their net income, divides it by 4,400, which is the average. Looks like their equity really grew. Their equity grew 25% almost, over 25%, I guess. So they have a 21.8% return on owner's equity. That means for every dollar of equity they have sitting on their balance sheet, they've generated almost 22 cents. So that's not too bad, huh? 22% return. I think that's quite acceptable these days, no?
Yeah.
Maybe not.
No.
Okay, now here's an important one here. Let's look at this one. You're going to be, when you get to 230, you're going to do a lot of this. There's a whole chapter on the AR, on the turnovers, turnover of accounts receivable, inventory, accounts payable, a few other things. So accounts receivable turnover, it's a measurement of the time to collect cash from credit customers. Let me say it more clearly. This metric tells you how fast you collect cash from customers. Okay? This tells you how fast you collect money from customers. And how do we do it? We're going to take the credit sales for the period, the credit sales, not the cash sales, because obviously they're not an issue in collecting. So all the sales that first began in accounts receivable divided by that average AR, and that gives you a turnover of 9.6. Okay, big deal. What's that telling us, the 9.6? Well, it means that it means that we collected the average amount of accounts receivable 9 times. Our average receivables were 11,500. So we collected them 9 point turnover. You talk turnover with your boss, he or she may just look at you like you're, speaking a foreign language. So what we want to do is turn that turnover into days. Everybody understands days. Very simply, if you divide a year, 365 days, by the turnover, you get 38.2 days. Anybody can understand that. So instead of boring your boss with the turnover, you say, boss, we dropped our, we're collecting cash really quick these days. We went from 40, say, to 38.2. The number of days credit customers are taking to pay. Comparing average collection period with business credit terms offers an indication of whether companies are paying within terms. And the calculation is simply a year represented by 365 days by 9.6. And in my experience, I would get a huge raise if I actually collected cash in 38 days. That's pretty darn good. That's pretty darn good. My goal, my metric to earn a bonus was 45 days, and that was tough to do. So 38 days is quite good. Now we're going to do the inventory turnover. The inventory turnover. This time, I'm going back here deliberately. This time, we're not going to worry about AR. We're going to worry about the payables, and we're going to worry about the cost of goods sold. We're going to, not payables, we're going to change accounts receivable to inventory and credit sales to cost of goods sold. It's the exact same calculation. Inventory turns, the number of times merchandise inventory was turned over. Higher rate of turnover, smaller profit required on each dollar sales to produce a satisfactory gross profit. Yeah, there's two ways to generate a nice profit. You sell your product for a lot more than it cost you, right? That's an obvious way. But the other way is you keep turning the inventory over. You sell a lot of shrimpy stuff quite frequently. Supermarkets, grocery stores are famous for high inventory, turnover, I meant to finish that thought, and a low profit per item. Milk, people are
Yeah, high
buying.
volume.
What's that?
It's the high volume. 'Cause
That's exactly
grocery
right.
stores are operated at like 1% profit or something, but they have such
Yeah,
volume that they do well.
yeah. But they may only make 5 cents maybe when they sell a quart of milk, but man, they sell many quarts of milk over and over and over. So that's how they generate some profit. Jewelry stores are different. A jewelry store might not sell anything in a day. I mean, I'm not an expert in the jewelry business, but I don't think people come running in there every day to buy certain items that they turn over all the time.
Yeah.
Here it's a higher profit per item. So we're going to take the inventory turnover rate, and what would you do with these turnovers? Well, you'd certainly compare them to yourself. Are you hitting benchmarks you may have set in your budget or your standard cost system? You're certainly going to look at prior years. How you doing with prior years? You're going to compare them to other companies that you're interested in, and you certainly want to see where you stand within your own industry. So let's take a peek here. The cost of goods sold for the period divided by the average inventory, again, beginning and ending inventory at December 31, December 31. We divide these numbers out, we get a turnover of 4.8. And again, turnovers are difficult to use conversationally. So we're going to turn it into days, 76 days. So what did this tell us? This company takes 76 days to sell their product from the time it arrives at their store or their warehouse. It takes this company 76 days to sell something. And then it takes them another 38 days to collect. So 76 is exactly double 38. Isn't that something? Closing entries. Now we've gone over closing entries. By the way, any questions, Rod? Anything that's jumping out here?
No, not yet.
Okay. Closing entries. Well, it's closing entries for a merchandise business. I guess earlier in the chapter when we were doing the closing entries, it was a service place. So the only difference is there's an additional merchandise account that must be closed. And we're going to do it with the worksheet. And you've heard me talk about this, I believe, right? Out with the old and with the new, or we've not gotten there yet. I mean, that's all you're doing with this merchandise inventory. Here we go. Here is our general ledger for the income summary. That's the account we drive all the closing entries through. So what are we going to do here? We are going to take the merchandise inventory out with the old. Here's a credit for $52,000. This represented the inventory. It's not telling us that, but it does. And then the new is the ending inventory is the, they have this backwards. They actually have this backwards. Remove the beginning inventory with a credit. I'm going to skip this screen here because I don't think this is right. And I'm going to confuse people, but this isn't that hard. So let's just skip. Here we go. Closing entries for merchandise business. They're just bringing it over. Oops, I'm sorry. Let me just move this out of my way here. Closing entries. We know we close everything on the income statement. The only difference is when we close the inventory, we're going to have to write 2 journal entries. So the best way to do this, and this is a review now from chapter 6, the best way to do it is in 4 steps, like the book said back then. Step 1, debit all of your revenue accounts or any income statement account that has a normal credit balance. We debit all of these and we credit that to the income summary. So the balance of the income summary at this time represents just our sales. We do the similar work with the expenses, which all have normal debit balances. So we're going to credit all the expenses and debit the income summary for this number, 379. The resulting balance in your income summary, thus, is the net profit. The net profit. So we come down here and we bring the net profit down here. We debit income summary, which zeroes it out, and we credit capital. That's the mechanism for bringing the net income over to capital. That's what closing entries are all about. Minusing out everything on your income statement and moving it over to capital. And then the one thing off income statement is the drawing, and that can be closed directly to Mr. Sangiri's capital account. Drawing will reduce the capital, which has a normal credit balance. And that leaves us with the post-closing trial balance. And you might remember this. After you've moved all of the income accounts and the expenses to capital, you no longer have any of them on your trial balance. There's a point in time at the beginning of the year where if you opened up your closing trial balance, you're not going to see anything but assets and liabilities and equity. And here is the closing trial balance. Sam Tangiri, he's now up to 513,600. Notice that the drawing is gone. You never put drawing on a financial statement. Never. That's not the business of the public. And putting it on there would possibly confuse people, or they would misinterpret it. Sam Tangiri, his company made a ton of money last year. That's all they need to know. They don't need to know that he took 4,000 out for his own purposes. And we're not going to get into reversing entries unless you'd like me to go over them, Ron. Okay, we'll skip reversing it. I don't know why we don't. I've asked this question a number of times. Reversing entries are super, super important. And I think one reason why they don't teach them is every computer system in the world does them automatically. Just real quick, any accrual entry is automatically reversed. Any accrual entry. So if you debit salaries and wages and credit accrued salaries payable, you're good in that month. And then the next month, it's immediately reversed. And there are reasons for that, which we'll not ponder here. Yeah, we'll skip this. Okay. Well, I guess we're done with today's session, huh?
Well, good.
No questions?
No. But do you have tutoring tonight?
Yeah, 5 o'clock.
Okay, I'll probably pop in there. Let me see my schedule.
Come in, meet some of the people we get there. We tend to get the similar ones. And
I have somebody at 5, but I'll probably be there around 5:30.
Yeah, I'm there from 5 to 7. And I'm there as long as it takes. I've been there late till 9.
Really, people stay there that long?
Once in a while, I'll have a student who really wants to, work hard. And if I sense that we're making progress, I'll stay there all night if necessary. But typically I'm done at 7. And then on Thursday, my 6-year-old grandniece from Pennsylvania joins us for the first 10 minutes. And this is so stupid. Her father, who's a dumbbell, he thought he had this idea that if he exposed her to me teaching the big kids, it would somehow influence her. And
I kind of agree with that to some respect, though.
I hope so. And
when I was a kid, my dad would buy college books from garage sales.
Oh, really?
Physics and math in different topics. In the summer would make us read it with my brother. So we would have to do physics and math, college level physics at like 9 years old, right?
Wow.
And memorize terms and ideas. And then he said,
amazing.
Don't worry about it, understanding it, because your brain will get it. And when you actually do it, you'll be fine. You'll relearning something is much easier than learning it the first time.
Yeah. I
Now,
tell
when I
you what,
took- Yeah.
my 6-year-old niece, she zones out after about 5-10 minutes of this stuff.
Right, but it's one of those things where it's staying back of your head.
Yeah, I think
When I
so.
took physics in school, everything kind of clicked, and
Yeah,
physics
yeah,
and math became easy.
I think so. So I think we all agree. I agreed with
So,
my nephew, and you're on the same page.
like,
And she likes the attention.
yeah,
A student comes in, and I'll say, "Who's your teacher?" And no matter who the teacher is, I go, "Oh, Adriana, what a
yeah.
nasty old goat this woman is." And my niece is looking scared there. All right, I guess we're good to go, huh?
Right, we'll see you tonight.
All right, see you tonight.
Thank
I'll be
you.
looking
And
forward
then
to
I'll
it.
send you an email about your stuff shortly.
Oh yeah, I appreciate that. I'll take care of you and everything right away.
Okay.
Thanks so much, Rod. Again. Hey,
Bye.
bye-bye.